Hi everybody, and welcome back to FANG Friday. This is Ross Healy, the Chairman of Strategic Analysis Corporation and a Senior Portfolio Manager at McNichol & Associates Asset Management. Following our FANG Friday YouTube video last week, I must have made one or two of you a bit nervous because we got a couple of requests which asked what sort of downside risks do we see in the FANG stocks. This is a decidedly more profound question than just following the shares from week to week, month to month, or frankly, even year to year, over the past 12 years when the FANGs have basically simply led all markets steadily higher, with the NASDAQ 100, of course, in particular, rising from its growth price, that's 3 times book, to in 2009 to its HB1 price, or 9.5 times book, in late 2021, early 2022. The question now is, where does that index go? And what will happen to its key members, the FANGs, and I suppose Tesla as well, if the market goes wherever it is slated to go? I think that you all know where the line in the concrete is as far as the NASDAQ 100 is concerned, as that would be the bottom of the market on March the 14th, when both the NASDAQ 100 and the S&P 500 reach their precise target lows. The bubble price for the NASDAQ, or 7.4 times book, and the super growth price for the Standard & Poor's, that's 3.5 times book. These levels are, mathematically speaking, two of the most powerful valuations in our SVA panoply. If they fail, the downside risks in the stock market are profound, and in particular for the NASDAQ 100 because its supporting values are so poor. In bear markets, in my 35 years of experience with SVA, stocks tend to fall to a discount to their intrinsic values to allow for investment recovery values to come back in. Well, the average FANG stock is overvalued by 44%. So your portfolio risks in these stocks is far from trivial or even modest. But not all risks in the FANGs are the same by any stretch of the imagination. So what I will do over these next 4 weeks is to examine 2 of the FANGs each week to assess what the risks are in each one. By the way, and for your information, I'm spreading this out because it takes much longer to evaluate a stock on a one-off basis, and I'm trying to keep our weekly video to the promised 10 to 13 or 14 minutes as a max. So I will do my usual weekly review of each stock and then focus on the downside risks, if any, for 2 different FANGs in each of the next 4 weeks. However, before we take a look at the FANGs, as always, I do like to say thanks to everyone who likes this video and all our subscribers. Well, let's start off with the easy ones, and I'm going to start off with the 3 cells. Okay, and as you can see with Alphabet, after the little rally following the March 14th low, it is carried right back on down again to it, and actually threatens, I think, to head at least to its mid-super growth price. That's 5.5 times book value. Netflix, well, the best that Netflix could muster in this whole rebound off March the 14th was a very, very small move to its HB1, and it's now heading right back down again. We're going to have to see what happens at the bubble price. As I say, that's a very strong valuation level. And finally, Meta, again, off its March the 14th low, it had a nice bounce. In fact, it even actually went just a little bit above the low super growth price. That's 4.5 times book, but it didn't last very long. And the reason, I think, is fairly easy to see. Look at the slope of the growth, or the not growth, of the fair market value. You can see why the stock has failed to do very much. Now, turning to our buys, our buy holds, the first one is Apple. And I've got to show you again here the issue with Apple. And that is to say that we are now waiting, and we should get a new balance sheet for this stock very, very shortly. Okay, one is now due. You can see these little triangles at the bottom. One is now due. And we're going to find out whether this big upswing in the balance sheet growth actually occurred or not. And what I have been able to read, it probably was not, that they had been buying back stock. Well, when we look at where the stock would be if they had kept on buying back stock, you can see here, if I put this dotted line here, you can see that on March the 14th, it looks very much as if the stock, if Apple came right back down to its putative HB6 price, assuming those stock buybacks. And so therefore, I intend very much to keep this as a buy hold. Amazon, well, Amazon came down to its HB1. That's 9.5 times book value, and it remains in that little channel there. We'll see if that channel can hold, and therefore whether the stock will either become a buy, bounce off the HB1, or sell if it fails to hold here. Now, I then had 3 holds, and well, let's go and take a look at the first one, which was Tesla. Here was our low on March the 14th. And from there, of course, the stock has had a very, very nice bounce. It went right up to its own HB6 price, which is 33 times book value, but it has not been able to break out there. So I'm left with a conundrum as to what to do with Tesla right now. Now, 2 stocks in which I am not, I think terribly proud of myself are NVIDIA and Microsoft. And here was NVIDIA prior to that bounce. And what you see here is that the HB4 price failed. That's 20 times book value. Actually gave me a confirmed sell, which is a 3% 5-day breakdown. But in the rebound following March the 14th, actually had a very, very nice run. However, it turns out that that sell may be serious, because the stock is set right back down again, okay, to where my sell signal actually cut in. Finally, Microsoft, same story. I had a beautiful sell on the HB3. We put it back on our buy list when it fell to its HB2, but look at that, the stock broke down. My 3% 5-day rule kind of cut in, but I ignored it because we were close to a bottom on the market. So I said, okay, we're going to have it as a hold. Well, it had a nice bounce, okay, but look at that. It's checked right back down to the lows. And the question now is whether or not this breakdown, this sell signal, was for real or not. Now, at the outset, I promised we would take a look at 2 stocks and what kind of downside risk we might be facing in them long term. And the first one I'm going to turn to, of course, is Netflix. And this is a stock I have not liked for some period of time. The stock broke down at its HB3 with bad earnings that really plummeted, tried to close the gap, but that has failed. And even on the bounce on March the 14th, it could not do anything more than muster to an HP1, and the question is where now? And I am concerned about this stock. The pressures in the industry are intensifying powerfully, not the least of which are coming from Apple now. And what's happening now is that the earnings forecasts, instead of increasing, are actually falling. And the question is, what could actually happen to this stock? Does history give us any idea? Well, the answer is yes, it does. Okay, Netflix has had two enormous falls from grace since 2000 and 2002. Okay, when it also reached well into its bubble zone. And indeed, in both cases, the stock fell right down to its super growth price. That's 3.5 times book value. Well, not wishing to alarm anybody, but this kind of looks like something like that is happening again. Now, I had expected that the bubble price might hold and we might get a bounce, but if it doesn't, I'll have to tell you that all of history that I have experienced using SVA tells me when the bubble price fails, the super growth price is coming up. That's $147. So I would be very, very cautious about Netflix. The second stock that I want to talk about in terms of potential sells now is Microsoft. And as I told you here, the stock got up to its HB3, gave me a sell signal, which I ignored. Well, it's given it to me again. Well, how serious is it? Well, why don't we go and take a look at Microsoft and see if history tells us anything at all. And I have to tell you, it does. Look at this long-term history. Now, in the early part of Microsoft valuation experience, of course, there we see how fast the balance sheet is growing, and they remember that these lines are the slope of the balance sheet. Well, that's slowed down quite a bit certainly in subsequent years. However, when I look back, what I see is that Microsoft peaked the last two times that it peaked at it, or very, very close to its HB3, and that's where it got to again. Well, if this is for real now, and it's starting to look as if it is, then the downside risk is at least to its bubble price, which is $183, and based on its past history, perhaps even lower. I think that I would ignore the recent sell signal at my peril. Now, in summary, not much overall has changed since last week. The poor are getting poorer, as I showed you when we looked at our three sells, Alphabet, Netflix, and Meta, and the rich are hanging in, as you can see with Amazon and Apple. It's the three holds where things have turned a bit on the unhappy side. Tesla went right up and hit resistance, but is now checking back. Personally, this is not a stock that I would own anymore. Although I have to admit that my son gave me a spin and he let me trial drive his new Tesla this past weekend, and it was one heck of an experience. Anyway, back to earth again. It turns out that I should not have tried to override my SVA service by ignoring a confirmed sell signal as I did with NVIDIA and Microsoft. I anticipated the rally up off the bubble price to the NASDAQ and held both those stocks. But after a decent pop, both have gone right back down to their recent sell lows, giving me a second sell, by the way. I hope that you've gained some insight into the long-term potential for Netflix and Microsoft. I suspect that industry pressures are weighing on Netflix, no matter how good their own product is. And Microsoft has seen its own 35-year valuation high, and that may be all she wrote. Before I sign off, I again recommend that you review the lows for the Standard & Poor's and the NASDAQ 100 on March the 14th and note where they are. That is the line in the concrete. Since we started FANG Friday, events have clearly shown that there are three ways that we earn our keep with our SVA market service. The first is to help you to find stocks to buy, and the second, today, as I showed you, how you might well avoid the kinds of big losses that the market can inflict with long-term holdings. Third, of course, is to get you into or out of the market itself. Now, if you want to join our investing community and become a client of ours, go to www.strategicanalysis.ca/pricing. And we'll see if SVA is right for you. For now, this has been Ross Healy, Chairman of Strategic Analysis Corporation and a Senior Portfolio Manager at McNichol & Associates Asset Management, reminding you that nothing, including investing, is difficult if you have the right tools.